Hey everyone, Colin with Zizzi Investments. What we're looking at here is data from the Morningstar Mind the Gap study. I put out a post on this a couple days ago and just wanted to follow it up with a quick video. So what this data is telling us is that investor returns have lagged the total returns of the markets on average by 1.68% in 2022. And this gap has been pretty consistent when looking back at each of the last 5 years as well. It's ranged from 1.5 to 1.7% annually. Now, a lot of advisors would say the value that they bring to their clients is that they can get better than average investment performance or that they can outperform the market. Now, this data looks at the whole investor universe, not just do-it-yourself investors, not just those investors working with an advisor, looks at the whole universe. And I know that on average, advisors are not delivering on that promise because the three categories that had the biggest underperformance, alternatives, non-traditional equity, and sector equity, those aren't investment categories that I see DIY investors utilizing frequently by themselves. Those are typically held through investors that are working with a financial advisor. So if that's the main value proposition of your advisor, we can see that on average, they're not delivering on that promise. In my opinion, the main value of a financial advisor is aligning the investment portfolio with the long-term financial plan and then backing into the investment return that we need to make that plan work. So that helps us to not chase returns. We know exactly the returns that we need to make that long-term financial plan work. And what I want to show here is how much that investor gap can really add up over time. So 1.5, 1.7%, that might not seem like a whole lot in any given year, but what if we look at that across the life of an entire financial plan? How much does that impact the plan? So what I show in this plan over here is we took the low end of this at 1.5%, shows how it impacted a long-term financial plan. And what I built is for a 35-year-old who wants to retire at 65, and then the plan goes out till age 94. So we show from 35 to 65 that person is in a moderate growth portfolio, getting 7% a year during the accumulation phase. And then at age 65 in the retirement phase is dropping down to a conservative portfolio at 5.4%. Well, if we look at, on average, they underperform these returns by 1.5% each year, how much does that impact the long-term financial plan? So that's what we show over here. If we look at the current plan where they're achieving the full returns, they have a 70% probability of success. We're not going to go into what all these numbers mean, but let's just assume for purposes of this video that 70% is a pretty good score on the Monte Carlo simulation. How much do those lower returns impact this score? So if we come over to the stress test then, we drop the returns by 1.5% annually. That drops our 70% down to 30%. So let's just assume 70% was passing, 1.5% lower returns, 30% is certainly not a passing score. So 30% means we're going to need to make some big adjustments along the way to make this plan work. And we can see if we held everything else equal in the plan, just that investor gap of 1.5% has a huge impact on a financial plan. So hopefully this video was helpful. If it was, please like, share, comment on the video. Don't hesitate to reach out with any questions. Thank you.